How's it going today, guys? So what we are talking about today is the price to earnings ratio of a stock. But first, I would just like to make a public service announcement. Okay, I don't know if you guys have this problem too. I just got my hair cut, and the damn barber did not brush the hair like off the top of my head. He just freaking trimmed it all up, brushed my neck with the powder. He's like, okay man, you're out the door. If you're a barber, please just use the blow dryer, man. Blow that hair off, because I've been like itching the back of my neck like crazy, and like I know the shirt that I have on is just gonna be covered in hair. And the barber I go to, he's good, but that just annoys me, and I just wanted to like throw that out there because I've legit been pulling hair like off the back of my neck for the last hour, and it's just bugging me. So I just wanted to throw that out there. Has nothing to do with investing, but hey, just felt like I would mention it. Anyways, we're talking about the price to earnings ratio of a stock. Now this is more towards like fundamental stock analysis when you're looking at the finances of a company. And mostly what I do when I'm trading is I look at technical stock analysis, but I've kind of been trying to learn more about this, and I have a lot of people asking me about this stuff as well. So I'm kind of new to this, but I've been doing a lot of research, so I think I'll be able to bring some value to the table with this information. So first of all, what is a price to earnings ratio? Well, you see it as the P/E ratio, or just the PE. That is the price to earnings ratio, which basically measures the current share price relative to earnings per share. Now, generally speaking, there's three price to earning ratios people use when they're looking at a stock. There's the standard price to earnings ratio, which takes the market value per share of the stock and compares it to the earnings per share. There's the trailing PE ratio, which takes the market value per share of the stock and compares it to the trailing 12-month earnings per share. And then we have the forward PE ratio, which is the market value per share compared to the projected 12-month earning per share. So you should be familiar with all three of those if you're doing any kind of fundamental stock analysis. Now there's a couple different names for the PE ratio. Sometimes it's referred to as the price multiple or the earnings multiple. And the best way to explain this would be that it is the dollar amount an investor can expect to invest to receive $1 of company earnings. So here's just two examples of that. Let's say a stock has a PE ratio of 20. That means investors pay $20 for $1 of company earnings. Now, if a stock has a PE ratio of 70, that means that investors pay $70 for $1 of company earnings. So there's three general rules with the PE ratio. We're going to go over those right now. A stock that has a high PE ratio means that investors are expecting higher earnings growth in the future. So there's a lot of, prospect with that stock, where it's projected that, okay, in the future, this stock should have better earnings. There's a lot of hope with that stock. Now let's look at a low PE ratio. That means that the company is either undervalued or it's doing a lot better than it was before. That would be a result of much higher earnings per share that hasn't been reflected in the market value per share. And then if you have a stock that has no PE ratio, it'll either say PE and then N/A, or if it has a negative PE ratio, that is because the company has no earnings or they are losing money. So here's something that you should consider when looking at the PE ratio of a stock. PE ratio of many stocks in one industry can help an investor determine the average value of $1 of earnings in that industry. The biggest thing I'm going to recommend, guys, when using the price to earnings ratio is it's best used to compare stocks within the same industry. So let's say you had the industry average fell around 40, so a PE ratio of 40, meaning if you invested $40, that got you about $1 of earnings in that sector. You could use that to determine if other stocks within the industry are considered overvalued or undervalued based on that PE ratio. So if the average was 40, and you found a stock that had a PE ratio of 25, that might be considered overvalued. And then if there was a stock that had a PE ratio of 75, that would be a stock that would likely be overvalued based on the industry average price to earnings ratio. So like I said, you only want to compare PE ratios of companies in the same industry or sector, as there is a vast difference in valuations as well as growth rates. So here's an example of that. Let's say you have a biotech stock with a price to earnings ratio of 25. It may not be a better value than a utility stock with a price to earnings ratio of 35, simply because utility stocks may be in favor. So you would want to use a price to earnings ratio to compare utility stock A with utility stock B, or the utility stock industry with utility stock A. But you wouldn't necessarily use the price to earnings ratio to compare a utility stock with a biotech stock. Okay, so now here's how you could tell basically if a trend within a stock or a trend is relative to the company itself or the sector or the industry. This is relatively straightforward here. But let's say that the stock price to earnings ratio was 50, while the sector average price to earnings ratio was also 50. A P to E ratio of 50 would probably be considered a high price to earnings ratio, but if the sector average is 50, that means that is likely a trend within that sector or industry. Now in contrast, if you had a stock with the same P to E ratio of 50 and the sector was averaging 30, that is likely a trend within the company itself. Now while the price to earnings ratio seems like it's a great way to determine the value of a stock, it isn't something you should use in and of itself. You should use it along with other indicators. This goes pretty much for any indicator. There's no one-size-fits-all indicator for a stock, and you can use it every time to determine if a stock is a good buy or if you should avoid it. You have to use many different indicators when looking at a stock. What I'd recommend to you guys is there is so much different stuff you could look at with a stock. You could get really into technical stock analysis and look at all the charts and data. Or you get into fundamental stock analysis and look at things like price to earnings ratio and all of those different metrics. But what you might end up doing is overwhelming yourself, and you might get to the point where you're finding contradicting information. So what I'd recommend to you guys is find a couple of indicators that make sense to you and just stick with those and learn to get better at determining what those mean. But you don't want to use just one indicator to determine whether or not you should invest in the stock. And here are the four main reasons why you shouldn't rely solely on the price to earnings ratio of a stock. The first one is probably the biggest reason, and that is because companies can make creative accounting choices to make the bottom line earnings bigger and the PE ratio smaller. And obviously the smaller the PE ratio is, the better value that stock seems to be. So the PE ratio relies heavily on the accuracy of the accounting of the company to report their actual earnings. Number two is the fact that forward PE ratios are based on the opinions of Wall Street analysts, which at the end of the day is an educated guess. So there's no guarantee that they will have those projected earnings. This is just their best guess. Number three is that it can be difficult to tell if a high price to earnings ratio is a result of higher expected growth or if the stock is simply overvalued. You'd have to look at other factors with that stock, not just the price to earnings ratio. You couldn't determine it just by looking at that. And the fourth reason is huge too, guys. A price to earnings ratio does not take into account the debt load of a company. So you have to look at a company and consider maybe they have a high PE ratio because they've taken on debt to expand their business. That would not be represented in that price to earnings ratio. Now, I know I just pretty much told you a lot of stuff about the price to earnings ratio, but I wanted to tie this in as well because this goes right along with it. And if you're going to understand the price to earnings ratio, you should also understand price earnings to growth, which is pretty much the same thing, but it basically compares that price to earnings ratio with the anticipated growth of a stock to see if those two are in line with each other. So that's called PEG or PEG, and basically what that is you take your price to earnings ratio and then you divide it by the anticipated growth percentage of that stock, and generally people are looking at the 5-year growth of the stock. So here's two examples of that, company number one and company number two. So company number one, they have a price to earnings ratio of 25, which means that investors are willing to pay $25 for $1 of company earnings. And that company has a 9% 5-year anticipated growth. Now when you compare company number one to company number two, you'd say, okay, company number one has a lower price to earnings ratio, it must be a better value. But then when you start to consider the anticipated growth of that company, that's where things begin to change. So the price to earnings to growth of this stock would be 25 divided by that 9%, which gives you a value of 2.77. I'm going to explain what that means in a second, but let me just run through this other example quick. Company number two, which has the higher price to earnings ratio, which would appear to be a more expensive stock, actually has a 35% 5-year growth that's anticipated. So their PEG would be 35 over that 30% with a 0.86 as their PEG. So what does that even mean? What exactly does that mean? Well, a company that has a price to earnings to growth of over 1, that means that the stock price is higher than the anticipated growth of that stock and it may be considered overvalued, or there is a heavy demand for that stock. If the price to earnings to growth is equal to 1, that would mean that the stock price is equal to the anticipated growth rate, and that stock is fairly valued in the market. Now, if that price to earnings to growth ratio is less than 1, which is the case with the second company here, that is because the stock price is lower than its growth rate, the anticipated growth rate, and the stock is maybe undervalued, or there's a supply of that stock on the market. So this is a good way to see if that price to earnings ratio is in line with the anticipated growth. So it's better to combine these two, because the price to earnings to growth gives you a better snapshot of the stock rather than just looking at the price to earnings ratio. Okay, so a few final points on the price to earnings ratio. The average market PE ratio is 20 to 25, so if you're looking at a stock, and like I said, the best thing to do is look at the industry average PE ratio of a stock and compare a stock you're going to invest in to that, because it varies so much from industry to industry. Second is that we already talked about this. You don't want to base any investment solely on one indicator. So don't solely base your investments based on the PE ratio of a stock, mainly for these 4 reasons right here. The other thing, this is very important, because I know a lot of people might say, okay, couldn't I just find stocks with a really high PE ratio, or maybe stocks with a really high PEG, and just short sell them because obviously they're overvalued? Well, here's the thing. It can take years for a market to correct for a high PE ratio. So don't just assume that a stock with a high PE ratio is due for immediate correction. It may happen years down the road, or it may never happen, or their earnings may increase and that PE ratio will come down. So don't just solely base a high PE ratio thinking that now that stock is going to all of a sudden come down in value. It takes years for markets to correct. Anyways, guys, that's pretty much all I got for this video. I know this was kind of a lot of information coming at you at once, but I tried to leave a pretty good description here as well. So if you guys want to kind of look over some stuff or take some notes, there should be some good stuff for you guys in the description. But if you guys enjoyed this video, please feel free to drop a like. Also, make sure you suggest any future topics you guys would like me to cover. I know right now I have about 100 topics written down just from things that you guys have suggested, and they're all great ideas, but it's hard to get through everything. But keep the ideas coming, because I want to always have a large list of things to make videos about. And if you guys are new to the channel, please consider subscribing to be notified of future uploads, and I thank you guys for watching this video.